Good morning, everybody, and welcome back. You'd be glad to know you're now in an AI-free zone. There will be no discussion of AI for the next hour. We are going more traditional, but we have a panel here on private equity's bold transformation of a life and annuity insurance business. So more of a focus on the life space and life and health space. And I've got an excellent panel here of Mark Eriksson, Anders Malmström, and Robin Raju. So I'll just give each of you a second to introduce yourselves to the group.
Great. Mark Eriksson, I'm a managing director at BlackRock as one of the global heads of our insurance group. And I think I was selected for the panel for my prior role where I was chief operating officer at Global Atlantic.
Anders Malmström, I'm the group CFO of Swiss Re, and I think I was also selected because of my prior role. I was at Athora before.
Robin Raju, I'm the CFO of Equitable Holdings. Equitable Holdings in the US is a top 10 wealth manager. We're a leader in the retirement space, in the annuity market, which is probably why we're here as well. And then we also own the majority interest in AllianceBernstein, who's our in-house asset manager, and they're in 25 countries around the world. But mainly US retirement focus will be the theme that we talk about today.
Great, thank you all. So to start off, maybe just, private equity and alternative capital of various forms have reshaped the life and annuity sector in quite fundamental ways in recent years. From each of your vantage points, how would you characterize the pace and magnitude of that transformation and the reason why we've seen it? Maybe Robin, I'll start with you here.
Sure, so I like the way we framed a lot of the discussions earlier today, and this is similar. It really starts with the end client. In the US, there's a huge retirement need. You have 4 million Americans that retire every year. You have higher healthcare costs, and they're living longer, and they want to do more in retirement as a result. And so, therefore, there's a huge, massive market that's underpinning this demand that will go into the overall annuity market, but why private equity has entered. Maybe some stats for you. The US retirement market is $46 trillion today. 10 years ago, it was $23 trillion. Massive growth in terms of need and demographic results across overall. The retirement gap in the US is forecasted to be $137 trillion. So ultimately, what we're trying to do with annuity products is to address that need and provide retirees security and the means to do whatever they wish to do in retirement. It may mean traveling, but it may also mean starting small businesses. There are more needs that people think about in terms of retirement, and we try to do that. Now, the fundamental question, before the global financial crisis, annuities were solving this issue. They were providing guarantees to clients to provide lifetime income guarantees, so income in retirement. What happened, and Andreas mentioned this earlier, companies were driven by growth in sales and were dependent on models. The models at that time said those annuity products, you would never lose money on them. And ultimately, the reason why is because, and I'll use Equitable as an example, not to pick on the industry, I'll pick on ourselves. Equitable, at that time, we wrote annuity products, and we assumed that only 8% of the people ever used the guarantees. So we saw a huge need, and the company and the industry was making a lot of money during that time, and they assumed they didn't even address the need because most people never used those options at the end. So the underlying product economics were built on not even addressing that need as the insurer, which is our primary responsibility in trying to address retiree needs. And as a result, in the global financial crisis, interest rates declined heavily, markets declined, everybody knows. But guess what? People hung on to those guarantees at the end of the day because they were very valuable to the consumer. And ultimately, companies like Equitable, luckily we were a subsidiary of AXA at that time, needed capital behind it. AXA infused $3 billion in Equitable at that time to keep it afloat. And many other peers either went to the government or had other ways to get that capital. So the industry, and at the same time, again, people are still retiring in the US, massive need. And so private equity actually came in and provided capital. Capital to insurers who needed to shed the legacy liabilities, and capital for end clients to address the retirement needs in the US. So they ultimately help address, private equity in many ways helped fuel and reshape and redevelop the insurance industry in the US, because we had to get away. These are 30-year liabilities that weren't going away, and we were able to partner with them, leverage their capital to reshape our balance sheet, and be there at a time now where we can be more growth focused and address the need of retirees in a sustainable way going forward. So the industry ultimately opened up the door to private equity. We talked about a little bit the domino effect in credit. Unfortunately, the industry had a domino effect in liability and policyholder behavior. And the industry led that decline, and private equity came in and addressed that, which honestly woke up the industry. So for me, I think it was a good thing in terms of risk management, philosophy within the industry, and grounding it across the board, but now ensuring that we're not going to make the same mistake in trying to address the retirement crisis in the United States.
Thank you, Robin. Mark, anything you'd like to add there?
Yes, that would be great. I think Robin, addressed, two of the big drivers in terms of, one, the demographic issues, and then secondly, some of the pre-financial crisis problems with the products. In terms of the why, Dermot, that you asked, why are these, private equity and private credit firms, coming into the space, particularly in U.S. life annuity? It's really about the product evolution that happened post-financial crisis, which was really a big shift to fixed and indexed annuities. So you knew as the insurance policy writer what the duration of those liabilities were, as well as what the payout was. And the most popular product in the United States in that space is a 5-year fixed annuity, which is a great duration match, and we're going to talk about ALM throughout this panel, with private credit. So the whole concept of the shift from bank to non-bank lending that happened in the United States after the financial crisis really favored insurance companies and asset managers who could replace depositors at banks for the funding of private credit and replace them with policyholders and investors in asset management funds.
So maybe just to add to that, I think all what my colleagues already said was a key driver, but there was an additional driver, mostly in Europe, but everywhere, that was regulation. So followed the financial crisis, regulation really tightened up. And the effect of that was actually that companies pulled products. So particularly in Europe, but also, you also saw that in the US, that guaranteed products basically got pulled from the market. Completely in Europe, more or less to a certain extent in the US at that time. And it was actually then private equity that came in. And when you look at Europe, and just as in brackets, the only capital that came into the market was through private equity. There was in Europe one IPO that was government driven, that was in the Netherlands because of NN. There's not a single other event that brought in new capital into the market. All that happened, companies had to give capital back through dividend and buyback. So private equity comes in two ways. One is they actually help the companies to do block trades, because they needed capital. And in order to free up capital, they said, okay, we take these blocks. We do transactions and put them into runoff. And that's what mostly happened in Europe. I think it happened. I think regulation is obviously also not happy with that. But that's where private equity came in. I think in the US you see much more, and it's also coming now in Europe, that it goes into new business, because companies cannot really survive in the long run just from in-force transactions. But that's really, I'd say that's the positive. I think it's the only capital providers that you saw in the whole industry that brought in new capital.
Yeah, so it's very interesting, really, in a sense, when you look back at all of that change, and as you guys were talking about the new capital that came into the market, and you compare that. Certainly, I'm Irish. All of the banks in Ireland collapsed during the financial crisis. We're now 17 years later, and the housing market is still suffering from the lack of credit, if you like, that was caused because there was no capital coming in. There was no new sources. There was essentially no mortgage lending for 10 years or more. And no building and no development. So you see it on other sides, but we kind of got reinvented by capital. When we see private equity coming in, what what they've done is they've used very often a mix of different regulatory regimes, a mix of direct and reinsurance firms, obviously asset side, clever financial engineering, if you like, in various ways is one of the things I've seen that as we've looked over the last number of years. It hasn't been just, a bit like the AI panel earlier, I said I wouldn't mention it, but we've talked people about reinventing the model. So sometimes the model has been reinvented, if you like, about how you should structure things. I mean, which particular pieces of financial engineering have been the most important as we've done that? Mark, maybe I'll start with you on this one.
Great. So, I think you're mainly asking about Bermuda without saying Bermuda. So I'll say it out loud. As you all know, Bermuda's been a insurance hub for many, many years, in its current iteration really with AIG in the 1940s. But there's been this explosion in the Bermuda market. And for those of you, who haven't been, following that closely, again, a few numbers, back in 2017, total assets on island were about 1 trillion. Today, they're about 2.5 trillion. So a very much an acceleration of on-island activity. And then secondly, a mix shift because of a lot of the points that Robin raised in terms of what's happening in life and annuity. So back in 2017, when it was only 1 trillion, it was 2/3 P&C and 1/3 life. And today, at 2.5 trillion, it's 2/3 life and annuity and 1/3 P&C. So the new entrants, again, like their P&C peers, look at every transaction and what makes sense to keep onshore domestically, whether it's in US, Europe, Asia, versus going to Bermuda. And there are different capital regimes as well as tax regimes. And from an RBC perspective, the US is mainly factor-based, which is a blunt instrument. It has its pros and cons. And Bermuda has a model-based regime. And so if you take a very simple, call it a $1 billion block of fixed annuities, in the United States, the amount of capital that you have to hold against that is somewhere between 12 and 14%. And if you move it to Bermuda, you're talking about something closer to 8-9%. So as we all know, as risk-based capital driven companies, that few percentage points of difference makes a huge economic difference to the shareholders of the insurance company writing those policies. So for every block or new retail annuity or flow reinsurance deal or pension risk transfer deal, the companies are doing the math and trying to optimize, what regime is it best suited in making sure that it moves to that jurisdiction.
Anders, anything else you'd like to add on that?
Yeah, maybe just a little bit background. I mean, I think you explained exactly why they go there, huh? But maybe let's start a bit, why are they actually interested in insurance? And I think that's the first question. And I think the key point is, I think you need to get the funding from somewhere. Huh? The banks are putting a lot of pressure on private credit. Huh? Basically, it moved away from the banks. The private equities saw that as an opportunity. And actually, when you step back and then see and have an asset liability management view, I think life insurance, in particular annuities, comes to mind, because that's where you have these long-term liabilities, and that's where you want to say, okay, that's actually a good funding for this long-term credit, medium to long-term credit. I think that's the starting point. Huh? And I think that's where you then can see, okay, it's actually better than on a bank balance sheet. Much better. Huh? You don't have the duration gap that you have on a bank. Okay, so now you say, okay, how can I manage that? To have a steady cash flow that I can match with the liabilities. And that's where then the search for the right regulatory regime comes in and says, okay, actually the Bermuda regime works pretty well. And all I need to do then is I need to take out optionalities. That's where then I think companies like we come in to say, okay, can we take the biometric risk to make these cash flows even more stable? And that pushed them almost. Huh? I mean, you can see this like a magnet. It has to go into these regulatory regimes, because that's the most efficient way then to manage that. But it all starts with It actually starts from an ALM perspective, where you bring long-term liabilities together with long-term cash flows.
Robin, anything you want to add?
I think in every liability, every company, you always have some form of financial engineering. So, and as a good steward, you should say, where's your capital best held, and are you appropriately covering the risk of that capital? And I think both traditional and private equity companies are doing similar. Where private equity companies, their edge, though, I don't think is financial engineering. It's really on the asset side. You know, they start with the asset where, you know, we've traditionally started with the liability. And they're able to source an asset. If you think back to Anders' point, private credit in the US, there are 200,000 small businesses that make up about 1/3 of the US GDP. Private credit is the funding source that make those businesses grow at the end. So it's really good for the US economy and for small businesses in the US to operate, because as Mark mentioned, banks have really stepped out of that place. So there's demand coming in there. Then they're trying to match it, as Anders said, to those liabilities that the insurance companies have. So they start with the assets. They have a huge amount of asset. What's the liability that can go towards it that has the cheapest funding cost, that Anders' point is? Versus traditionally, we started with the liability, and then we ended with the asset on it. I think at Equitable, we're trying to do both. Now with our ownership in AllianceBernstein and the retirement business, we call it this flywheel effect, where how can we make sure that they're creating value and we can enhance the value going forward? So we can source cheap liabilities, but also have assets that generate attractive risk-adjusted yields that make consumer products better. So it can, again, keep going and going and going in this flywheel effect that makes it better for the US consumer at the end. I think ultimately both private equity and traditional players have to ensure that we're keeping the trust of our clients. Trust is the most important factor that we have in a business. And so we need to ensure that regulators, and help regulators too. In the US, you have 50 state regulators. It's impossible to staff the regulators with the appropriate means in order to put in place good insurance regulation. Regulation always lags innovation. And so we, as the industry, I think, play an important role in educating the regulators, because we need to keep the trust of our clients. And so whether private equity or traditional players, whoever it may be, if we can all come together and ensure whatever it is that we're keeping trust, that the capital is appropriate behind these products, and that it's sustainable over time, I think it's a good thing for the industry.
Yeah, and I think one of the things that was interesting from my perspective, if you go back to the financial crisis and some of the insurers you mentioned, Robin, that struggled in the financial crisis, was that, you know, sometimes the regulatory regimes meant that, you know, we talked a bit about ALM. People weren't doing appropriate ALM because either the accounting regime or the solvency regime didn't match up. So it was like, you know, even though economically you would want to do ALM, people weren't doing ALM. So, you know, when we talk about going to Bermuda and so on, you get much more closely economic matching between the assets and liabilities, which therefore allows the insurers to be more stable over time.
Yeah, and with regulation, I mean, in the US, for example, global financial crisis, variable annuities brought down the industry. The regulation to fix that was passed by the 50 states or the NAIC was in 2019. Mm-hmm. That's how long it takes for something that's just in your face, that's clear, that's evident, but you have to have consensus across different regulatory bodies to put in place something that's more economic. It's nonsense that it takes that long, and as a result, then the industry is just coming from behind. Now, there are two forms, though, that you could take as a regulator. You could say, I'm not going to do it at all, which is not good as well, because ultimately then you're going to stymie growth, and you're not going to have future growth and touch more consumers. Or you can, and I think, honestly, Bermuda has found the middle ground and really have an economic regulation, where you're matching assets and liabilities together. You're stress testing it off of different scenarios, and ensuring you have enough capital to cover your risk. And I think that's what we want, is good regulation that's fully economic. And so that if people do something that's not economic, they have to hold more capital for it at the end of the day. Very simple. And I think Bermuda has actually found the right middle ground in having good economic, especially after some of the reforms that they've recently made.
I'm going to change tack a little, and Anders, you mentioned earlier about, you know, the runoff blocks being picked up by PE, and where that's kind of where it started, if you like, in providing capital, therefore, to insurers. But we've seen an increased focus in more recent years on organic growth. We're seeing more and more PE firms with organic growth, and, you know, do you think there'll be a change of focus from those firms to, you know, organic growth and kind of providing the sort of retirement things that Robin was talking about earlier? Or how do you think that's going to move over the next number of years?
Yeah, look, I think we're getting into a more BAU environment here, where basically all we talked about becomes normal. Huh? You bring assets and liabilities together. You want to provide good service, good products to the consumer, and that goes through the new business. I think that's a key driver. Huh? Mm-hmm. And everybody who's done transactions realizes that actually, if I want to continue, I need to do that. Because if I just stick to in-force transactions, I'm in constant troubles on the expense side. Mm-hmm. Because I take a portfolio, it runs off, I have to adjust expenses, I have to wait for the next one. I think it's get more competitive, and I'm kind of in this spiral. So I think it really comes from these two sides. Huh? One, it becomes normal from a BAU and from an offering, and actually it's not sustainable to just do runoff. Huh? Mm-hmm. It's brutally hard because you're always in cost. Huh?
Yeah. Yeah. And I think they could also source more assets at the end of the day than what's runoff provides. So you have to go into more BAU, new business, and attract more customers in order to place those assets. As Mark highlighted earlier, in the U.S., the fixed annuity market has essentially doubled in the last 5 years. And the number 1, 2, top 5 players are going to be Apollo through Athene and KKR through Global Atlantic. And what's changed, though, I think for them at least, is they've now put insurance on their balance sheet. So that's a very different change that we've seen in the industry than it being funded through funds, PE funds, et cetera. They're now putting it on their balance sheet, and I think that makes it more credible for new business as well, versus some of the smaller PE firms that may be funded through different vehicles that may not have that same legitimacy.
And I might come back to that topic later, I should say. Mark, you're coming from BlackRock and originally from Global Atlantic, and do you want to give your perspective on kind of where it's going?
One additional point I would make is that all top 10 of the private credit firms in the world who have 100 billion plus in assets have now either bought an insurance company or have a strategic partnership with them. All of these companies, except Apollo, who've been in it, for 10 plus years, all other 9 are new entrants in the past 5 years. And so they're all new to this market, and they are figuring out their business models as we speak. There's a question which was raised in the first panel of will they be there in 100 years, like most of your companies, we'll see. But with respect to that, as Robin said, Apollo and KKR, these are on balance sheet, wholly consolidated entities. Blackstone has a portfolio of minority investments. Companies like Sixth Street and Carlyle have invested in reinsurers who are only doing block reinsurance. So there's also a clear focus now on UK PRT, and I think we'll touch on whether or not these companies get involved in the P&C markets as well. But I would say it's an evolving landscape. Most have been in the markets less than 3 years. So looking ahead, what happens in 3 to 5 years, I think the only thing that we know is it's going to change from what it is right now.
Thank you. And sorry, I should have said before we started that I do intend to open up for questions later on. So if you have questions, kind of have them ready and be willing to, and maybe in 10 minutes or so, I'll open up to the floor for questions. Robin, at the start, you mentioned kind of the importance of policyholders from this, but like a lot of the focus, at least initially, was on maybe securing the policies that had been written and of recapitalizing insurers and creating new things. But with all of the change that's happened in the last 5-10 years, what do you think have been where do you think policyholders have gained? Because that's ultimately what it's really about here. It's about, can we provide better solutions for policyholders? So what's the upside for policyholders been as a result of all this change?
Well, because of what all has changed, policyholders now have more options and solutions within the insurance industry, at least in the U.S. Without private equity, as we mentioned, there wouldn't have been the capital in the insurance industry to solve policyholder needs. I mean, it's sad when I give you these stats, but the S&P 500 trades at a 23 times multiple. Most diversified insurers in the US, life insurers, trade at an 8x multiple. So we're not attracting capital as a public company. And so without capital, you can't write policies and you can't provide solutions for clients. And private equity has done that. So I think in that form, it's really good, and we're touching more clients. Equitable has benefited. We have more clients today than we did 10 years ago. And so we're addressing a bigger need in this US society. And I think insurers, there's no way an insurer should trade at an 8x multiple in terms on a relative basis. Like, what we do for society is great. We're providing people the means to retire, to live their dreams, security. It's such a differentiating aspect, and that's what they see coming in the industry, in these steady cash flows, these steady premiums that are coming in that can be invested in assets. And so as an industry overall, the more we can attract more clients, it's a good thing. And I think that's one of the big changes that's been addressed through private equity.
Anders, anything else you'd like to talk about on that topic of kind of the impact on kind of what the benefits for policyholders are?
Yeah, look, I think Robin said it. Ultimately, I think we have products that otherwise we just wouldn't have. I mean, it's what I said in the beginning. In Europe, you don't get guaranteed products anymore since the financial crisis. Huh? Companies just pulled it because it's not viable. Huh? And it's maybe slowly coming back now, but no public shareholder invests in a company that is providing these guarantees. It's just gone. Huh? I think we from Swiss Re, what we can just provide on the biometric side. I think that's where we can help. But on the investment side, it's just not going to happen. And if you actually then find a way that you can generate a little bit more extra yield, and we're talking about even if it's 20, 30 bips, I think that ultimately comes to the benefit of the policyholder. And I think that's a good thing. Huh?
Yeah.
That's a good thing.
The only thing I would add is that I think the new entrants, beyond the traditional insurance company policyholder, are also pushing the boundaries of where they're taking the industry to broader, as Robin noted, to the broader retirement space. So addressing the pension funding issue through pension risk transfer, as well as now moving in the United States into the defined contribution space and bringing a lot of the insurance know-how to our retirees, through 401k plans.
Yeah, I mean, my history, I suppose, is started my career and spent the first 20 years of my career with a traditional life insurer who had a lot of on-balance sheet liabilities, a lot of fixed annuities and other products like that. And the sort of investment return we were getting, or we were focused on really, was government bonds and high yield, corporate bonds. So what that led to in terms of the value you could get customers was kind of limited by all of that. But what I've seen happen is that, you mentioned 20 or 30 basis points on there's maybe it's more than that, and so, but we didn't really focus on the asset side. And what I've seen is that we now have experts on the liability side and maybe more carefully watching for the risks that you talked about earlier, Robin, and experts on the asset side. So experts on the asset side saying, hey, how can we generate more return, but within a context of trying to do it in as risk-free a way as we can. And ultimately that should lead to, especially as competition, as you said, has now come in, Mark, with more and more entrants, lead to better returns. So policyholders are getting better options and more options, like Robin said, but also within those options, better returns, I would hope, that some of that extra yield is being passed on to policyholders. I want to move to a topic that you kind of alluded to, Mark, a second ago. We've seen, and this was more or less a topic in the first panel, I would say, when the CEOs were talking about, we've seen traditional private equity subject to some regulatory scrutiny. And, Robin talked about this, we talked about this a little bit, but we've seen more regulatory scrutiny as we've seen, the market grow. We see some concerns in the US with, all the 50 regulators, but looking at, hey, all the assets are moving to Bermuda. We see some concerns here in Europe. We've seen one or two failures, but how do you think the firms are changing their models to adapt to all of this? And maybe, Mark, I'll let you kick off on this one in terms of how the structures of these firms are being changed to give kind of more confidence to the buyers.
Yeah, great. So I think maybe just to bring up some examples that might be on people's minds. So we've had two notable private equity-owned insurance companies fail in the past 3 years. One was Eurovita in Italy, and another is in Connecticut called PHL, or the old Phoenix Life, which was owned by Golden Gate Capital. So I think each one, every insurance company failure has its own issues, but Eurovita was mainly an ALM mismatch. Their largest asset was Italian government bonds. And so when rates went up in 2022, the value of those bonds went down a lot. You had a mass lapse event, and they didn't have the capital to meet the policyholder obligations. PHL in the United States wrote a lot of those pre-financial crisis policies that Robin alluded to in his opening remarks. My judgmental opinion from afar is that the private equity buyer who acquired PHL didn't really understand the liabilities that they were acquiring through that company. And again, in 2022, when you had a significant change in interest rates, the value of those liabilities changed, and the inevitable happened. So there's a lot of other near misses that have happened, and some frauds. But I think these events definitely make regulators nervous. And I would say when I speak to whether it's state DOIs or insurance regulators or central bank people who ask us these questions, all of these incidents come up. So how the new entrants have responded to that, I think number one, as Robin already noted, the two biggest players, Apollo and KKR, these aren't fund investments. And that's a really, really important differentiation, because as being part of the core balance sheet, and not having an end date where you need to return capital to fund holders, it's viewed by regulators much more favorably as a source of permanent capital. Given the Eurovita example with Cinven, when Cinven was forced to divest from Viridium in Germany, I can tell you that BaFin clearly favored a permanent capital solution. They wanted really insurance company money, and through the leadership of Allianz, Viridium came to a good place. But I think as we look at more transactions on the go forward, if the perception is that the capital or the acquirer is not a permanent stable holder, I would expect more regulatory pushback. And maybe I'll hand it over.
Anders, anything you'd like to add on that particular topic?
Yeah, look, I think, it's absolutely, key what you just said. The ownership structure is really important, and I think regulators made it very clear that we want this permanent capital, basically owning. I think the other point that I think is important is also then the relationship then to the asset manager when it comes to the asset itself. And it's not just the ownership structure itself, which is important, but also when you then go to the asset manager, actually having an asset manager that has skin in the game helps you a lot on the risk management side. Because if the asset manager just provides you a product and gets fees, I think it's a high risk. If the asset manager provides you a product that if it fails, he also has an impact, gives you way more kind of certainty from the insurance side of this equation. And I think that's where you see also differences in the market. I think that's where we need to have a look at as an industry, because if it's just about fee generation in return of assets that have a higher return, I think we should have red flags coming up. If it's all one, I think it will work.
Robin, any final points on that topic?
I think the industries and the regulators are still trying to get their arms around this asset intensity that some of the PE players bring. We have a lot of reforms that we're working on in the U.S. They take time, as we discussed. But the primary concern I would have is these smaller private equity companies that are now reaching. They see the success of an Apollo, a KKR, and they're trying to replicate it without the same asset capabilities, but they have the funding. And so as a result, they end up just taking more risk on the balance sheet. And those are the types of concerns that we as an industry need to make sure that regulators are aware of and work with regulators to prevent anything bad happening.
Maybe we need to start having the concept of soft markets in the life insurance space as well. Too much equity flowing in, too many, it's kind of like the opposite. It's the same as what we were hearing in the P&C discussion earlier on among the CEOs. That's what it sounds like when you're talking about it. But it's obviously a very important area. And I think that there have been important changes made as a result of some of the failures you've talked about, Mark, and of some other things. I want to talk a little bit about Europe. And Anders, I'm going to put this to you first. But, we've seen a growth in private equity in North America and Asia. And you mentioned this a little bit earlier, that we haven't really seen the same growth in Europe. And to some extent, that's been because of maybe low interest rates, but also because of the regulatory regime in Europe. And it's hard to put together guaranteed products. Do you see opportunities? Do you think is that a penalty on European? We talk about this all the time. Sometimes we see issues in Europe about the European economy being impacted by the inability to invest assets. But do you think there's also presumably an impact on the policyholders? I'm just interested in your thoughts in that area.
Yeah, look, I think Solvency II had its impact on the industry, and I don't really see that coming back completely. Obviously, rates rose a little bit, so that helped a bit, but there's actually more coming back right now. So I don't really see a big change on the product design. I would say the one exception actually is Italy, where I think they have these guaranteed products, but they have other issues. And I think your Rita was a perfect example where you see what can happen if you have a quick rise in interest rates with guaranteed products with a minimal kind of surrender value.
Yeah.
You go back into what we learned 30 years ago is the biggest risk on guaranteed products. And actually, it still happens. I think the regulatory environment, I think you saw that, is, I would say they just put more scrutiny around the ownership structure, which we saw in Germany in particular. I think you will also see it probably in other areas where I would say the US is more open to that than Europe. And I think UK is somewhere in between. Yeah.
Mark, any comments you'd like to add in that space?
Yeah, I think one note on the regulatory response and the divergence between US, Europe, and Asia, post-financial crisis was, to bring up another sore subject, insurance companies globally were some of the biggest holders of AAA subprime RMBS. And the US and the European Asian regulators responded to that in different ways. So in the US, the main crackdown was not on insurance companies. The main crackdown was on the rating agencies, not to create really securitizations of what really should be below investment grade and through financial engineering into investment grade. In Europe and Asia, the regulatory response really fell significantly on insurance companies to say, we are going to make the capital charges for anything that looks securitized so unfavorable so that it's basically uninvestable. And I think that's basically been the regime that the European Asian insurance companies have lived through from financial crisis to now. Some reforms to Solvency II were introduced this year for implementation in 2027, which will not bring it to where the United States is in terms of favorability for securitization, but it's going to make it less punitive. So instead of, for example, a 35% capital charge for a AAA CLO, you're talking about something like a 7-8% capital charge. So bringing it back within the universe of investable assets from totally uninvestable. And the reason why I bring that up is securitizations are really the gateway for most insurance companies to buy a lot of the private assets, because the way you pool, whether it's consumer loans or mortgages, and put them on an insurance company balance sheet is through securitization. So by the European regulator, and the Asian regulators have really been following the European path forward, the European regulator opening that door, I expect in the coming years, that will open the door more also to private credit.
So Robin, you're US based, so I'll give you a pass on this one if you like, but if any comments you'd like to add on that particular topic?
Well, just I think, Anders hit it on, Mark. And I mean, Solvency II just doesn't recognize the value of credit risk premium at the end of the day. And that's going to be an issue. I mean, part of the reason AXA IPO'd our US business Equitable was because you could not grow in the US under Solvency II. You couldn't. You have to take credit risk. And you're penalized, as Mark just spoke about, with capital charges that are not really economic. But it is a little bit naive, though, to assume that all liability risk is okay, but asset risk is bad. I mean, it's really a challenge that everybody has to bring together on both sides. Like, liability risk is just as risky as asset risk. At the end of the day, our role is to be good risk managers on the liability and on the asset side. And so I think that's something that Europe needs to continue to modernize, and also the US on the other way too. So.
Yeah, I would say as a kind of an external observer that, taking Mark's point, I think probably Solvency II went too far in terms of treating these assets, but possibly the US in different ways didn't go far enough. And it's about getting that right balance, because we don't want to have some event that causes chaos from all of that. We've about 10 minutes or so left. Anybody want to put their hand up? We'll start here and then we'll come here. Just got a microphone.
Thank you. Hi, a quick question for Mark, and then maybe, if I can, a quick question for Anders, and they'll both be quick. So in the in-force block business, whenever a deal is done, it usually goes out to 10, 12, maybe even more players. And it's not like traditional reinsurance where you win a 15% share and at your price, and somebody else wins a 30% share at their price. It's all or nothing. And if Fortitude wins the deal, then everybody gives Brian Schreiber a hard time and says, like you overpaid for it, which happened recently. And if Global Atlantic wins, then they give Alan or Manu a hard time for what they did. So my quick question to you would be, what's going to happen in 20 years? Did actually the winners overpay for their business, or can certain companies see value in one block of business that another one can see? And my quick question for Anders would be afterwards is, when you talk to BaFin, the regulators, the life regulators there, who I'm friendly with, say, there's no way I'll let some private equity company take on German policyholder risks if they're not a German company. How do you get around that? Do you have to wait till that regulator dies? Or is there a way to convince that regulator that actually it's better for the policyholder even though it's not a German company?
Okay, so that was 2 minutes just to ask the question. So we're going to have to be pretty quick in our responses. So, Mark.
Sure, I'll try to give a short answer to that question, which deserves a long answer. We can talk about it later. So I think on the block side, I think number one is the liabilities are the liabilities, and clearly different people can model those out differently. But there shouldn't be a fundamental difference in the understanding of the liabilities. And I think there's an example in the marketplace where that happened and the regulator took a stance. So I think for the block reinsurance, it's really the difference of opinion about what can you do on the asset side against those liabilities, how much risk are you willing to take, particularly on any types of duration mismatch and therefore reinvestment risk? So I think those are real questions. And for better or for worse, on a very long term, 20 plus year duration block, whether it's in life and annuity or pension, we likely won't know the ultimate ROE on that block until 10 or 20 years out.
Anders,
Yeah, maybe very quickly, I cannot talk to individual cases here, but I think what you see different forces here. I think you see the regulators, but you also see the governments that are behind. And governments they just don't want that, let's say, non-Europeans start owning too much of the local industry, and they use a bit the regulator to probe questions. I don't think that the regulator would ultimately say no to permanent capital if it's well structured, if it's well kind of supported, but they give them a hard time and they look for alternatives. I think another very important point that we didn't really talk about actually comes indirectly. That is that 80%, 90% of the private credit is actually sourced outside of Europe. And I think that's a bigger concern for regulators and governments. They start to understand the benefit of private credit, but what they really don't want is that then you have US middle market in a German annuity book. That's what they don't want. They actually push harder to make sure you can actually source that source of credit also within Europe, which is not that mature than what you see in the US.
Right. But there's resistance against that due to bank.
From the banks, exactly.
So we had another question over here in the front row. I think there's a microphone somewhere.
Yeah. Thank you. Quick question. No doubt the insurance industry in US and elsewhere have done tremendous progress since the great financial crisis in 2008 in the recent capital management, gigantic progress. Do you think the industry today is more or less resilient to the next credit crunch?
Robin, do you want to kick off on that one? I think the industry is much more resilient today than it ever was. That doesn't mean it's bulletproof, though, to be clear. But the industry is more resilient today because we've learned that losing trust does not work, and it's not sustainable. Second, I believe stress testing is much more evident in the industry. Not one scenario. You have to run multiple different scenarios and really understand where can you actually lose money, or where are you economically, the way we look at it on the economic model, where are you economically insolvent? And therefore, then you have to hedge or you have to take less risk to protect that. So in the US, at least, I can say the regulation has moved much more towards hedging market risk, and you're penalized if you don't. You'll have to hold more reserves. So I think that's a good thing. And on the credit side, it's really stress testing, and I think rating agencies have improved quite significantly in their ability in assessing some of the private credit risks. Not perfect yet, but still the stress testing is evident, and people are speaking more broadly about it as well. And then we also see it in pricing. We don't see the pricing in the market as being irrational. And I think when we look at it on an economic basis, if it's not irrational pricing, that's something to be said as well.
Anders, anything you want to add?
No, maybe not much, but maybe the one thing, I think the industry became much better on ALM, much better on ALM. I think on credit, I think the proof still need to be given. We didn't really have a credit crisis since a very, very long time. And I personally feel that when you look at the credit spreads, it's not really reflecting the true risk that we see in this. That doesn't mean it goes bust, but I don't think the market itself is really reflecting the risk that's in the credit market.
Mark?
No, I think these guys covered. So.
Yeah, and I think my position would be with Anders a little. I think the ALM is much better, but I'm still a little bit worried about the systemic, as we were talking about earlier, will they be around in 100 years' time? What's the systemic impact of a credit crisis, and do we know all those knock-on implications that we're going to get? Do we have one final question anybody wants to ask? A very quick one, over here. A quick question and a quick fire answers.
I just think private equity has got a completely different take on how long they want to keep their capital. They have an average duration of 5 to 7 years. How does that even work with an annuity business? I mean, I come from an organization where we had Warburg Pincus, and they're 7 years invested, and they're already looking to exit. So how does that align?
So Mark, so you want to...
Yeah, so I think the quick answer, I think your point is 100% correct on fund investments. where there is an obligation to return capital to the LPs. And that's why I think there's this difference between those entities which are being invested via funds versus strategic on-balance sheet investments.
And most of the duration on a lot of the fixed liabilities where the private equity players would operate in are much shorter, to Mark's point. So they're looking at 3, 5, 7-year type of liability profiles versus traditional annuities where you can be there for 20, 30 years. So I think that's a pretty significant difference.
So I see I've got to minus on my clock here in front of me. So I think we'll wrap it up at that stage. I want to thank Robin, Anders, and Mark. Thank you very much for your